Hey, what's up? Greg here. Welcome to DLA Markets. I thought I would do the Fed update this week as a live stream and to get it out to you quickly. So here we are. All right. So today it was another day in the markets, and the Fed came out, and as you probably know by now, they raised the Fed funds target another 50 basis points, and the market immediately sold off as a result. And a lot of it had to do with the press conference that ensued afterwards, where Jay Powell probably threw some cold water on a lot of the market's expectations with respect to moderating of interest rate rises, and also the expectation that some people have, although I really can't understand how they could have this opinion, but some people thought that somewhere in 2023, the Fed would actually start lowering rates. Okay? So before we get into some of these conclusions, let me just sort of run through what happened today. I watched most of his press conference and the question and answer period, so I think I got a pretty good impression of where he's coming from and what the conclusions were of it. So I want to give that to you now. So he had the press conference, and he basically said that yes, inflation is coming down. We know that it peaked some time ago at 9.1%, the CPI, but he said food and other necessities are still persistently high. And he said in particular, the labor market is still very tight and wages are still rising, okay? And for those of you who don't know, labor cost is a major component of inflation. So the Fed is keeping an eye on those labor costs, and they continue to rise because the labor participation rate is only 62%. And you would expect at this point in the economy, it would be much higher, 65, 67%. But apparently, a lot of people are out of the labor force, able-bodied men and women, for whatever reason. Maybe they're getting government assistance. Maybe they decided to retire. Whatever the reason is, the labor participation is extraordinarily low at 62%. And this is causing wage inflation. And he also mentioned the service sector of the economy still is seeing their costs rise significantly, and this is causing inflation to be remarkably stubborn and difficult to bring down. Okay? Now, the result of this is that he was saying that he anticipates that the interest rate increases are going to continue well into 2023 and perhaps all the way through 2023. And one thing he said in particular that I thought was particularly interesting, given some of the narrative I've heard in the market and some of the market sentiment and what I consider to be nonsense that I've heard over the last month or two, is that he said pretty much emphatically, I don't know how much clearer he can say that, is he said, do not expect interest rate decreases in 2023. Okay? To me, he's essentially saying that this problem, because let's face it, we still have CPI at 7.1%, okay? We still have a 7 handle in front of CPI, all right? And he's targeting 2%. So we have a very long way to go here with inflation. And I just think it's incredible to me how many market participants discount this and are still thinking that they're going to stop raising rates and even start making rates come down like in the near future. I think this is ridiculous, and I think that this kind of sentiment really caused the market to sell off today, where a lot of people just said, "Wow, things might get real here," and that's personally the camp that I'm coming from. I think that we still have a long way to go, okay? S&P earnings are at 19 times earnings. I mean, that's way too high to be in an environment where you have restrictive monetary policy and the Fed is raising interest rates and tightening credit by reducing its balance sheet. I mean, that's way too high. I would expect earnings to be 14 times, 15 times, something like that. And I think that argues for more volatility in the stock market, more sell-offs coming, and I would maintain a defensive position as a result. Another interesting thing he was kind of predicted. He predicted GDP would stall in 2023, even though we've seen some modest increases in GDP. He thinks that GDP will stall and we will go into either a flat economy or a recession. He said there's absolutely no way we can tell at this point if it's going to be a soft landing or a more serious recession. There's really no way to tell. I personally think, and I've expressed this on the channel previously, that if the Fed keeps raising rates, and I think they're going to, as this persistent inflation continues, they're going to break something. And I think what they're going to break is the economy. Okay, that's my position. That's the way I feel. Let me know in the comments if you agree. So I think the conclusion of all this, to me, is crystal clear. I don't know why there's so much debate about it, but I guess that's human nature. That's what makes a market, right? A lot of people disagreeing on things and different people having different views. But I think it's crystal clear that the rate increases are going to be going on longer than anyone thinks. I guess the people that make odds somewhere, wherever they make them, in Las Vegas or someplace, the sentiment is that the terminal rate on the Fed funds rate is about 5.1%. That's the consensus. I don't know if that's right or not, but I think the conclusion is rate increases are going to go on longer and higher than probably most people think at this point. And I think that the market is far from a bull market at this point, and we can look forward to being in a bear market for some time, perhaps all the way through 2023. And I don't think the market's certainly not acting like that. Okay, it's up roughly 10% from the October low. The market, to me, is not acting like it realizes that or believes that that's going to happen. Well, time will tell. So as it relates to the market, my market forecast is basically that S&P earnings multiples have to come down. Okay, I think with interest rates rising, I think one thing that people aren't really factoring in to a lot of their views on the prospects for business is that with these rates rising and rising and rising, I mean, it seems obvious when you talk about it, but a lot of people don't seem to understand, whether it be companies, okay, whether it be commercial real estate, whether it be residential real estate, all of the trillions and gazillions of dollars of debt that these companies and commercial real estate properties and everything that occurs throughout the entire economy, when it comes time to refinance this debt, the rates are so materially higher than when these loans were originated, and this has to do with the corporate side and the commercial real estate side. Those are the two areas I'm most familiar with and most active in. When these properties, for example, commercial real estate, get to the point where they have to be refinanced, many of these properties are not going to be able to be refinanced at the higher rates. The sponsors or the owners of these properties are going to have to put money in. And when that happens, there's going to be hell to pay, because a lot of the market is just going to go into incredible distress. And remember, this is all occurring against the backdrop of declining liquidity. Okay, the Fed's not only raising interest rates, they're sucking liquidity out of the market by reducing their balance sheet $95 billion per month. Okay, so you have liquidity leaving the system, and at the same time, you have interest rates rising, and that lack of liquidity is going to cause tremendous distress, not only in the commercial real estate market, but also in the corporate market. Okay, in the corporate market, credit spreads have blown out. Not only has the Treasury market gone up on the short and longer term end of the market. Of course, the longer term market has rallied recently, but overall interest rates have gone up. Credit spreads have blown out. That's the difference between the theoretical riskless rate of the Treasury bills or bonds and the spread to that rate that a particular credit or company, credit of the company, requires to be financed in the market. And this is true across investment grade credits as well as junk bond credits, and particularly junk bond credits. A lot of those companies that have junk credits are, developing companies or growth companies. These companies are not going to be able to refinance their debt because their balance sheets won't be able to handle it. And I really don't think a lot of this is being factored into the market. I really don't. And what happens is human nature. People don't focus on it until, the shit hits the fan, and then all of a sudden everybody's focused on it, right? But you have to look ahead as an investor and really anticipate some of this stuff. And that's what I try to do on this channel, and I hope some of these comments are helpful to you, okay? So focus on the revaluation that's coming through in the market. And the revaluation of assets, I think, is going to be a very big thing coming up in both the corporate and the real estate commercial market. Now, residential is another thing. Prices of residential houses have got to come down, and they've got to come down materially. Affordability is a major problem now. Many young people don't think they'll ever have enough money to buy a house. This is a horrible situation to have in America or anywhere in the world, because for many people, owning a home is their only real way of attaining any meaningful wealth. And many people are just priced out of the market. In past cycles, you've seen 20, 30% drops in many markets in the residential market. Housing market, and I think you very likely could see something on that magnitude in the next year or so. Now, talking about risks, everybody focuses on interest rates as risks to the market, the financial markets, the stock market, the economy. Everybody focuses on interest rates. I have stated for a long time, and Jamie Dimon recently agreed with me, and I'll put that video in the end screen at the end of this live stream on the replay. I'll put it up here. I just recently did a video on Jamie Dimon of JP Morgan, who stated that the geopolitical risks that we are seeing today are far more dangerous to the world economy than rising rates. And I agree 100% with this. And I've made several videos, and I've stated this, many times before. If you're a subscriber, you're probably tired of hearing me say this, but what's going on in Ukraine and China, but more Ukraine, I would say at this point, is just unbelievable. This war in Europe, it's expanding, it's not ending. I just heard that Belarus is maybe gearing up to join the war on Russia's side. I mean, this would be a horrible escalation. And aside from just the conventional warfare aspect of this, If it ever goes nuclear in any way or form, all bets are off and everything. I mean, a dirty bomb or a tactical nuclear weapon, whatever it is, the energy markets would go crazy. $200 oil would be, almost a foregone conclusion. The world economy would probably crash. I mean, it's a horrible thought, but even if it's just a slow grind going forward the way it is now, with the U.S. funding it, with Europe funding it, it could just go on for a very, very long time. And it's a continuing and very important risk to the economy of the world. And it should be thought of and factored in a lot more than I think it is in the markets. In terms of portfolio strategy, I'm still a bear, obviously. I think we're still in a bear market. These rallies can be large and powerful. As I've said, the market's up roughly 10% from the October lows. I think these rallies are bear market rallies. I'd use them to raise cash, stay liquid as possible, avoid obviously growth stocks that don't make any money, where everything's on the come. That strategy is not going to work in this market, as I'm sure you've learned in your 401k and elsewhere. Still like oil and gas and energy. I'm going to probably be coming out with a video on CVR Energy, which is another company that I'm starting to get very interested in. Carl Icahn owns 70% of the company. I find that play very interesting, so keep an eye out on the channel for some content on that. Still like Exxon, Chevron, integrated oil companies. Still love it, still believe that there's a structural supply-demand imbalance in oil and gas. That's not going to change anytime soon, particularly with the war in Ukraine continuing to rage on. So I still like those sectors. I would selectively be looking at, you got to be careful because you're going to show short-term losses, but I've said for a long time I still like some of the mega cap tech stocks rather. Google is one that I still own. And you can trade this market because it's very volatile. Although one thing that I find extremely puzzling, which I've talked about quite a bit, is the VIX. The VIX, it's at 23 now. I don't understand why the VIX is so low. With a setup like this, with a market like this, with the Fed implementing such tight monetary policy, I don't understand why the VIX is in the low 20s all the time. And that's why I've said previously that in order for the market to eventually turn around and for there to be, a bottom, so to speak, the VIX has got to be much, much higher, 50, 60. At the height of COVID, it got as high as 85. Okay, so it just shows you how I don't understand. There's no fear in the market. People are still bullish in spite of an incredibly negative setup with the Fed and all the other factors that at least I look at. So in conclusion, I would say in terms of market strategy, stay defensive, keep your cash levels relatively high, because eventually there's going to be a blow-off, sell-off, so to speak, where that would indicate some kind of a market bottom. And at some point when the direction of monetary policy seems to be changing, that would be an obvious buying opportunity. And then I'll have some more ideas with regard to that. Okay, so that's the market update and the Fed update. The Fed is not changing their position. I really still feel like we're at the beginning, not at the end of this process. They've got a long way to go. We're at 7.1 on the CPI, and he's targeting 2%. So we've got a long way to go here. And so I would say hold on to your money. Don't make any big bets. You can trade the market if you want to, but continue watching this channel because I try to give you as much market intelligence and my experience over many years of being both an investment banker and an investor, both in the stock market and in commercial real estate. I try to give you the benefit of that experience, and I hope that that you're getting some value out of it. And if you do get value out of it, please like and subscribe, because it really helps me on the channel, and it helps me to continue giving you this content, which I hope you find valuable. Okay, so thank you very much for watching, and I'll see you on the next video.